Hello and welcome to another episode of the Swing Trader Status Update. This is our monthly webinar that we do for folks to kind of just go over some of the stuff that we're talking about on our Swing Trader product. And we go over markets, we go over stocks, we go over portfolio management rules because we do treat the Swing Trader product as a model portfolio. And to help me out with that, he's joining me as he does every month. It's Mike Webster from a remote location in a basement somewhere, undisclosed. Our senior market strategist, of course, Mike Webster, and also the brains behind Swing Trader, for good or for ill. You take
For
them.
ill.
Well,
Yeah.
right now, I'd say year to date, the fact that it stayed positive is still a feather in your cap, and look, it's still a very strong year of outperformance year to date. It's amazing what a crash can do for you, right? In terms of outperformance.
Yeah, that was, people aren't really talking about it like it was a crash. And as far as I'm concerned, that was a crash. It wasn't like 1987, or the flash crash, or certainly wasn't like 1929 because we recovered. But that was a crash. And it was very reminiscent of, kind of the bear market that we had in 1998, but we didn't have the double bottom, so in hindsight, it is more like the COVID bear market. So it's really like only two examples that were really like this. So it was very rare, and I'm glad that we navigated it the way we did. I'm very proud of the team.
Yeah, just to kind of, again, for folks that aren't as familiar with that time period, this was kind of what we were thinking was going to happen. This was the 1998, of course, for those that remember, long-term capital management needed a bailout, and we had, everything going on from Russian currency, Asian contagion currency, a lot of stuff really kind of putting, and not to mention it was the late 90s, right, where so many people were already kind of looking at, wow, we're so extended from the 90s in this bubble. It's you had the irrational exuberant speech a whole year before all of that. And it still went on. I mean, you certainly didn't want to miss 99 because that was one of the greatest years ever. So and then, of course, as you were saying with COVID, that was a much more V-shaped. There was no W there. It was just the V, not the double V. And yeah, really kind of came out of that very quickly. I would say much more quickly than I think most people would have expected, especially if you were looking at the headlines. But this is where that follow-through day really helped us get on the right side of things for that market.
Yeah, absolutely. And then, you have to trust the follow through day system that Bill O'Neill, came up with. And then, all the other bells and whistles and things when it comes to market analysis, that we've added, with like the 21 day and the power trend and things that you and I developed along with Charles Harris when we did the market school rules. And that is really kind of dictating how we're treating this market because we are in a power trend, and that is not something you get all the time. They don't always work out perfectly, but if you're going to have a really strong move in the market, pretty much they always happen with power trends. And so if people aren't aware of what that is in a nutshell, it's just you have four things that have to happen. Your 50 day has to be in an uptrend. You have to close up on the day. Those are the easy ones. The harder things are your low has to be above your 21 day for at least 10 consecutive days. And your 21 day, which is your green line, has to be above the red line, which is your 50 day, for at least 5 consecutive days. So if you have all four of those things happen, turns on the power trend. And when that happens, you operate differently. You operate more offensively than you would in any other time. And then ultimately, when the 21 day crosses back below the 50 day, then the power trend is essentially off. There's some other, you know, nuances in there, but we don't really have time to get into it. But really, if you close below the 21 day, you want to start, kind of changing and being more defensive, even though the power trend is still on and just waiting for that low to get back above it. But we've maintained the low above the 21 day for a really long time, and that can go longer than anyone would think, including us. And so you
Mhm.
just you have to deal with all the wiggles and wobbles, and we had some that we're going to recently that we're going to talk about. But the market looks really strong. It looks like it wants to, go to new highs, frankly.
Mhm. And, just to kind of point out, this is when the power trend started. And look, a power trend doesn't mean you go up every day. The power trend started and we immediately had a little pullback below our 10-day moving average line, but quickly recovered. But one of the things we're going to talk about today that is worth noting is this downside reversal day that we got on June 5th, this past Thursday. And this is again one of the things that we studied a bit in market school. um, of course, it's as with almost everything with market school, we want to revisit it and redo a bunch of things and put some of those stuff in ATRs, which if you haven't seen Mike Webster's visit to the IBD podcast, Investing with IBD podcast, he did
Who did I
that just
do that with? There was some really
yeah,
cool
some
dude I
some
did
guy.
that podcast with.
So he
Yeah.
just did that a couple weeks ago. We had Joe Fahmy follow him, but we had ATRs went into a deep dive on that. So that's one of those things we would probably add an ATR component to the spread here. But look, we had this downside reversal on June 5th. Usually, your expectation is for some weakness to follow that, and if you don't get it, or even better, you kind of have this situation that we had here where you very quickly uh, take out the reversal day high, and actually the S&P 500 did that immediately. So here's the downside reversal on the S&P 500. Next day, you've already taken out the high of the reversal day. It's kind of like no harm, no foul. You're back on board. What weakness expectation?
Yeah, so the downside reversal, is a big deal. Like you said, we do need to dust off those rules and adjust them a bit, but they are, still solid. And there's some that, will make it through those rules that we wouldn't really want, and other ones that we would want that don't make it through those rules. But that was a clear downside reversal. And what you always say, I love your, well, you tell the story. Pretend I'm going to come hit you.
Wow, it's already getting violent. Okay, so yeah, the idea is that look, if you're in even if you're just boxing for fun and you're sparring with a partner and they're going for a body blow and it's coming, right? You can see, oh man, here comes the hit. You've got a choice there, right? If you can't block it, uh, tightening up your stomach is not a bad idea, because if you don't, that's going to knock the wind out of you. It might knock the wind out of you anyway, but at least if your stomach is tightened and kind of ready for the blow, you can handle it a little bit better. And we think of that with downside reversals is, hey, this is telling you that some weakness is potentially coming. Not a bad idea to be ready for it. Doesn't always happen, and sometimes you can turn right around and things are just fine. But it never hurts to be ready for that and be ready to take that punch if necessary.
Yeah. So if you're swing trading and you get a downside reversal, tightening up your stomach means translates into raising cash and getting, reducing your margin or getting off of margin, having some, powder dry for it, for opportunities that would typically come, maybe 2 or 3 days after that, or sometimes a couple weeks after that. And so you want to, at least the way I look at it, is you want to sell a lot that first day because typically you're going to come lower. And I think you ran the numbers and it was over 80% of them. You don't get that downside reversal buyback right away within the 2 days. This one, we did get it on S&P right away. NASDAQ, we finally got it today, which was on our third day, which, right now the current rules is we want the what's called a downside reversal buyback buy signal to happen within 2 days. And so what that is simply you have your downside reversal. And if you get a close above the high of the downside reversal, it negates the downside reversal. And in any of the selling that you did, you need to kind of reverse that and just say, okay, it was just a one off, one of these kind of rare things where you just have one bad day. And that was, I think, there was some, weird news that was happening that day, and then just everything started selling. But then people got to think about it overnight and wasn't something that was going to impact the broad market. So everything bounced back. So you have to shift. Now, if you're position trading, which is not what this product is about, if you're position trading, lots of times you can just sit there, maybe trim a little bit or even do nothing because you're going to let your stocks wiggle and wobble more. But with swing trading, it's a different animal and you want to adjust and, lock in some gains, sell anything that that is questionable, raise some cash. That's what we did. But then as soon as we got back above it, we had to switch gears. Yeah, I was frankly thinking we were going to come into the 21 day, which is the green line. I thought it was going to give us a lot of really nice buys there, easier buys, but that didn't happen. So you don't fight the market, you just roll with it. And we started, increasing our exposure, um, back, and and we're continuing to do so within our rules. We're not going on margin right now, and that's something we'll talk about a little bit.
Mhm. Absolutely. And you know what? It's probably worth mentioning today, or you know what? Before we get to that, maybe we should take a look at some of these downside reversals, a historical example,
Sure.
because we were going through a number, and 2003 and 2020 both kind of offered some interesting ones. You chose 2003, right? Or did you?
I could
Or
do
2020?
2020. Yeah.
2020. Okay, so let's go there. I'm going to change the date here, and you know what? We're going to go back to the Nasdaq. So again, as a reminder, we had our COVID crash here. Very, very steep correction. The world was coming to an end, but then we got our follow through day on the Nasdaq here on April 6th.
6.
So right here on this day. So man, sometimes it's hard to get that scalpel like precision. But you know what? I think I can do it with my line here. So here is the follow through day. And look, it wasn't straight up, right? We did get our power trend in here. But while this was a very strong move, we did have, I mean, gosh, I remember this day. That was no fun. I think I lost 10% of my account on that day. Like just
Did
in
you
an hour.
misplace it?
Yeah, right, exactly. And I made the mistake of telling my wife how much we had lost that morning, and she's like, Don't ever tell me that again." Like, she like gulped, and yeah, I lesson learned. But we had a number of downside reversals. I mean, look at this one. This is just um so this is July. Let's see. This is July. This one sticks out. This is July 13th. And while this one sticks out quite a bit, you actually had one right here. And this one, kind of like what we just saw, very quickly, had that buyback signal. And then you had another downside reversal. And as soon as you started getting back to highs, this one was an immediate buyback, but you eventually started hitting highs again. And what do you get? Another downside reversal. So, just because we had that kind of recovery quickly doesn't mean we're necessarily out of the woods. But it's certainly uh, you can kind of lean a little bit more bullish when you do get back to those highs, when you don't get that expected weakness.
Yeah, so I think this is a really good example, because of that first one. You get that first downside reversal, and it looks so small now, but that's because you had some, really bad days after that. But at the time, it would have felt, significant. Not certainly not as significant as that other one. Yeah, like, right there. But you just adjust, not on the next day, because that next day was an inside day, so it wasn't really proving anything, but it was that second day, that then you close above the high of your downside reversal. So that's your downside reversal buyback where you readjust. Now let's go out to the one on my father's birthday. Um and There is
Oh,
someone who's turning 80 this year.
wow,
Yeah, that's a
that's a
biggie.
big milestone.
That's a real biggie. So this is more normal, right? You have this downside reversal. You've kind of gotten overheated, and you can think kind of in terms of like almost like a channel line, not an exact perfect channel line, but in that spirit of a channel line where it's at the top and it just needs to readjust. And so it then becomes a magnet for the 21 day, and that's what I thought we were going to have happen this time. It didn't. So let's go out to the next day here. um and this is, if you had sold on your downside reversal, which you should have, on this day you can ramp things back up because now you have something from a swing trading standpoint. You have something to trade against. You have your low, which is next year 21 day, plus you have an upside reversal. So even though we know that it didn't go straight back up, whenever you're looking at a chart, you want to pretend like you don't know what had happened. And so with this information, I would say, okay, you're in this volatile zone because in 2 days you've really swung from a high down to a low in a big way, but you can tell that the market is getting supporting action, and so
Mhm.
then you adjust. And so if you're swing trading, you've got to be
You
kind
know
of
what? I
quick
want to
with
add
things.
one thing
Yeah.
because that point that you just made about like, okay, you don't know, you got to trade the market you're in, right? You don't know
Yeah.
what's going to happen, and so often people will look at a day like this and say, oh, well, that was obviously a shakeout, and you wouldn't have wanted to sell anything. But remember, at one point during this day, it was at the lows, looked like it was going to take out the 21-day moving average line. So to your point, this is where selling some on the downside reversal gives you a little bit of, a little bit of a cash position to weather that storm when you're down at the lows this day to hopefully survive and not puke out everything at the lows when you're feeling all that pressure and not being able to sit through the reversal part.
Yeah, and that is the real key takeaway with this. So even though this time was about the 15% give or take, where you have the downside reversal buyback in our current market, most of the time you don't, and you go lower or you go sideways for a little bit. Let's go forward a few weeks just so they can see what ended up transpiring. That if you don't sell on that first day, and I used to not sell on the first day, and I'd be like, oh, I'm too smart, I'm not going to get shaken out of things. And you have a really bad day that first day, kind of like what you were talking about, where you told your wife how much you lost. Then the next day the pressure really builds because like on the low of that day, you're starting to think, man, I should have sold yesterday. I would have, should have, could have, and all that stuff. Then the third day happens and you get this gap down where everyone capitulates, and you're capitulating, or at least I used to capitulate then on that third day, and that's where it would turn and go up. So I've just found that sell a bunch on that first day and you can always buy them back. That's with swing trading. Position trading, different animal. You what you have, and you try to hold your best for last, and all of that fun stuff. But this is kind of normal when you have this range that it had to trade in, and then eventually went back up. So I think we can go back to our current market, just to see where we're at.
Okay, here we are back at the NASDAQ. And again, this was our Thursday downside reversal. It remains to be seen. Do we get kind of like we did in 2003 and 2020, a little bit more of this sideways action? It's certainly worth mentioning that today, as great as it looks on the indexes, that's not necessarily what it was looking like for a lot of growth stocks. I mean, I know for my account, and SwingTrader, was actually not as bad as my personal account. SwingTrader was better than that. But man, this morning I was not having a great day. A lot of stuff was really coming in on me, and especially on the growth side. And it was one of those days where I have a TQQQ position and I have a U Pro position, and I'm like, man, I just wish I had more of those,
Yeah.
because those were doing fine, looked great, and a lot of my stuff was not looking nearly as nice.
No, and that's pretty much the way it was for, you know, almost all growth, not all growth stocks, but the majority of stuff that we're trading, that I'm trading, and that you're trading personally. That it feels like over the last week or so that the money has been flowing out of that and into some other things. And I was, when I was doing my screening today, I don't know how they closed, but there were things like Coca-Cola and Johnson & Johnson that were moving really strong, but like good growth stocks were down. Like, yeah, I'm not going to buy Coca-Cola here, but and pull up Johnson & Johnson as well. I think that one was, well, not that big of a move, but when you're the stocks that you're in or looking at are
Yeah.
down, and you see
Everything
stuff like
looks good
this.
relative when you're
Yeah.
stuff is sucking wind.
So a good thing to look at then is RSP, which is something that we have on the list, which is the equal weight of the S&P 500, and it gives you a sense of what the normal stock is doing, not necessarily the value or the growth or the really slow pokey Coca-Colas and Johnson and Johnsons. And this looks nice. It had come into the 21 day, last week, got support there, and it's moved up, but it's not ripping up. So your average stock looks healthy, and it looks like it wants to take out that marked high of the 180.18, and that would be healthy for the market, and why we're playing this as well as the U Pro on
Mhm,
Swing Trader, because you do get these group rotations that happen, and so having some broad based ETFs like a U Pro, like an RSP, things like that will help in days when your stuff is getting hit really hard, and then you have that to kind of balance things out. And so that's what we've been doing.
mhm. And I just want to point out, so for UPRO, um, yes, it is triple leveraged. And again, I do have a position in this myself. It is
As
triple
do I.
leveraged, but ATR is 3.6, percent on that. So yes, it is triple leveraged, but that's still on the milder side for a stock, right? So we're very comfortable having a triple leveraged position there when we're in a good spot in the indexes. That's certainly not how we started out. If you recall, for those of you that have been taking the product for a while, you'll remember that in April, we started with SPY, not UPRO. And part of the reason was because SPY had its ATR over 3%
Mhm.
during that time because of all of the volatility that we were seeing here in April. So, yeah, we didn't want to go with a 9% UPRO ATR. We said, okay, let's be very cognizant of where that ATR is, what that will do to our portfolio, and we'll also talk a little bit about where that is right now too, and how we've been really kind of managing that, looking at what that portfolio ATR, again, something that we did talk about on the podcast in detail. But for anyone that's a little uncomfortable with the leveraged idea of ETFs, and look, we understand. Yes, there is the contango, and this is something that you want to really be leaning into in an uptrend. But as a swing trading product, we're very comfortable with it because we're not going to be sitting through sideways action and downtrends on this. So all of those things with contango that really can get out of whack with these leveraged ETFs, we're not going to really subject ourselves to that because of the short-term nature of our product.
Yeah, I don't really like dancing, so the tango is not for me.
Okay, not even contango.
Oh,
So
not oh,
especially not
okay. I
contango.
misunderstood what you were talking
Yeah.
about.
You just yeah, selective hearing.
Yes.
So yeah, you know what, let's get into some of the charts, and unless you had some other things that you want to talk about
No,
on the
I mean,
market
there's so
side.
much to talk about, but we don't have 5 hours, so let's whatever you want to pull up, let's do it.
Okay, let's get into some of our charts, and I'm gonna start with let me get back to my sharing, and we'll share this. So this is our performance chart. We typically are looking at a 50-day rollback period, which we are going to show those as well. But we want to just kind of get that overall picture of year to date. In terms of the performance chart here. And you know what, this looks like it might not have something's getting cut off here. So it's not going to be cut off here because I think we just dipped below the 21-day moving average line. We
Yeah,
have our
we are
equity
below.
curve.
Yeah.
Yeah. Oh, you know what it is? I know what it is. There's I have this this bar right here that's covering um covering
Oh,
the percent invested, and that's what was causing the problem. So yeah, there's our stuff.
yeah.
That's where we're at. So yes, we have dipped below the 10-day moving average line on our equity curve. We did that on Thursday with that downside reversal. We actually dipped below it a little bit, but came right back. And you can see we did adjust our percentage invested. This green area chart down below is our percent invested. So you can see how we sat out a lot of the crash here, and then We had some moments where we, dipped below 50, but we kind of got off margin here, went back heavy. That downside reversal, that's taken us back off margin. And because that equity curve is below the 10-day moving average line, we're waiting for a little bit more evidence that we can turn that around before we start getting on margin again. So you see us pegged right here. We're really being very careful not to get on margin. We'll be okay staying fully invested, but we're not ready to get back on margin yet.
Yeah, so I think one of the things that folks can do is to really help out your trading is to create an equity curve yourself. The way Justin does for this product, and then put moving averages on for swing trading. A 10 and a 21 day, like we're using, I think is very helpful. If you're position trading, maybe a 21 and a 50 as well as a 200 would be relevant. Focusing on the 21 and the 50, not so much the 200. And then you adjust as you're going below them or back above them, or also at new highs, or if you're going under um, low areas. So because you don't want to wait until you're in this massive drawdown to start changing how you're reacting. So what we do is when we come underneath the 21 day, like, or the 10 day, like we did last week, we look at it and go, you know what, it's time to adjust things. So our position sizes for individual stocks, we went as our base case. There's always exceptions. Our base case of a half position. So our full position is 10%, half position is 5%. So we're adjusting there. So we're reducing our risk. We're capping our maximum invested at 100%. And as you said, we're being very diligent there. And with ETFs, we're keeping those at full as a starting place. And so we want to lean when you're coming into like a period like this, where it's not like we're struggling, we're just doodling around there and not making the progress that we want to, nor what the market is doing over the last you know week or so. And so what we want to do is dial things back. And so having more ETFs than stocks, and then when you have stocks, doing them smaller positions is the prudent thing to do. Now, if we just rip out of here, you can do the Monday morning quarterback and go, oh, well, you should have done full positions. But we're managing risk, and we're trying to teach that through this educational product. It would be a lot easier for us to just pick stocks, and not think of it as a, and lots of services do that, and there's nothing wrong with that, but that's just not what we want to do, where you just say, okay, I like XYZ stock and ABC stock and whatever, and just leave it alone. But we think of everything in terms of portfolio management. This is a mock portfolio that we're doing, and treating it this way as a way of just kind of trying to educate and help people who want to trade this style, and always feel like you can adjust it. But this is a big deal for us, the equity curve, and that really overrides everything else. We start with the equity curve, and then everything else kind of falls into place. So once we can get that little purple line back above our blue and our yellow, which is our 10 and our 21 day, then we'll start going back on margin, and we will go to full size individual positions. But you know that'll happen when it happens, and
Mhm.
we'll adjust. But until then, we're dialing things back. Now, if we were underneath there for a long period of time, which is going to happen, then we might even go into quarter positions, and have a cash component in there, depending on how poorly we're doing, regardless of what the market's doing. Like, if the market's ripping and you're doing poorly, something is out of phase, and so you just need to dial back your risk, not just keep on, not have the FOMO and just put the gas pedal down, regardless of what the feedback is that you're getting from the market.
Mhm. And I'm reading some of the YouTube comments. Thank you so much for everyone that's watching live and watching the archived version, which we get up there pretty quickly after we're done. But yeah, a lot of people are saying, man, the progress has been a little bit slower. Feels like a hamster, on a hamster wheel, running a lot but not getting anywhere. Two steps forward, two steps back, and look, we had such a strong move out of the gate. Sometimes there is a little bit of that pause, a little bit of sometimes it's sector rotation. Some of the leaders take a little bit of a break, and that's all very normal and natural in a cycle, in a bull cycle. It doesn't go up every day. And as you said, that's why we try and have an element of portfolio management skills that we're trying to teach as well, to you know help with that, because at the end of the day, it's not just about the individual stocks, although that makes a big difference. It's also about how you're mixing your portfolio together to weather storms and yeah, and periods where things aren't always clicking exactly right. And I mean, we had a day, I think one of those days where gold was up a lot one day, and then the next day it came in, and we were underperforming. And it's not that anything major was wrong. It's just that kind of a lot of little things added up to a day of underperformance. And so we're very aware of those days. We don't necessarily throw out the baby with the bathwater and say, oh, we have to go all to cash, but we have to make adjustments to the portfolio, how aggressive we're going to be. Do we lean a little bit more heavily on ETFs, half positions as opposed to those full positions, and individual stocks and high octane names, even. So
Well said.
let's also go ahead and take a look. Speaking of ATRs and those high octane stocks, one of the elements, and this is our 50-day rolling period. So we're very aware that right now we've come in a little bit, and we're kind of getting even with the S&P 500 over the last 50 days. Someone asked if just based on their kind of observation, they were like, "Oh, was May not a great month?" We still outperformed the S&P 500, both April and May. But it was, at the end of May is where you started to kind of see a little bit of that turning. And then certainly the start of June has been a little bit more challenging. And so, yeah, you can see that while we did outperform in May, it did start to dip kind of a little bit at the end there, which might have made for that feeling. But here is our ATR. And all we do, and this is something again we talked about in the podcast, we just take a weight for each stock. What is it weighted? What is the ATR? You multiply that together and then sum it all up. And of course, cash is going to have a zero ATR because that doesn't move at all. We're not taking into consideration inflation. This is all kind of short term. So since it doesn't move, that can bring your ATR for your portfolio down considerably. And if you have some very high octane names, of course, that's going to raise your ATR. Or if you're on margin, that's going to make it so that you have a higher ATR for your portfolio. So this is where we're at right now. And part of that is, hey, we are underperforming a little bit. We're under our 10-day moving average line. Let's not have our ATR so high. You can kind of see this is where we were, really putting the pedal to the metal and gassing it almost at a 5% ATR on margin. And then we've come off that considerably and are treating things a little bit more carefully, treading carefully.
Yeah, so this is not by accident where this HCR ends up. This is by, design and how we do it. And I think you did a great job explaining that. And I think folks should watch that podcast that we did together a couple weeks ago, so you can, do this for your own portfolio and be aware of how much risk you're taking with it. And I was looking at, so May we were up 7.39% and the S&P was up 6.15 according to your spreadsheet. So we've outperformed the market every month this year, I believe.
Mhm.
But this month is where we're underperforming, and that's why we're adjusting, because you don't want to go into a tailspin. What will happen is lots of times when you first start underperforming is you're like, oh shoot, you still gas it down to make it back, and then
Right.
that's when bad things can
That's when
happen. So
bad things happen, right?
yeah, so we're being very prudent with this. Now everyone can you can adjust it, like if we're putting half size positions on and you feel very comfortable going to a full or bigger, go ahead and do it. But we are going to continue being very prudent because, again, the most important thing with this product is the portfolio itself, not the individual stocks, not the tactical decisions. It's the overall, and then everything goes down from there. And so as we start um, getting back, in the swing of things, and our EC or equity curve is back above our moving averages, you'll see this ATR start getting closer up to 4. Like 4 is
Hmm.
about where I feel comfortable, or where we feel comfortable, where you're in sync and you're pushing it hard, but you're not being reckless. Sometimes you'll get up to 5, even higher than 5 in special situations, and that's when you're risking chips that you have. Meaning, like, pretend like you're at a poker table and you're at a tournament. If you've got a bunch of chips, if you've got a big chip stack, you play differently. When you've got a smaller chip stack, you also have to adjust, and that's what we're doing with this. So when we have a lot of chips to spend, which we do, but not in the very short term, we don't. Not for June. For June, we're underperforming, so easing, we're easing off and dialing things back. Once we get back above the S&P for June, then we will adjust. And so this is what I think everyone should be doing. And when you see us put things on and take things off, and you might not understand why, because we can't sit and explain, all the details of every single decision. That's
We
what
can't we
these
can't do a video the entire market hours.
Yeah, that would be, yeah, that would be not ideal for anybody, unless you want to sleep, but so what we will do is, make little changes and then look and see, like, why are the guys doing this? We don't just like throw stuff at the wall and see what sticks. Like, every single change is really well thought out. Doesn't mean they're all going to work, but there's a lot of thought that goes
Mhm.
through everything that we do, and that's what you should do for your own account.
Mhm. I also just wanted to point out again, of course, we mentioned this at the time. We knew when the S&P 500 was at its lows, our relative strength versus the S&P 500, of course, skyrocketed because we were sitting in cash and not taking the downturn, and that really helped. But we know that that was going to be probably the peak for our relative strength, and we've been keeping time though. We've been generally outperforming again, as you said. Each month we have outperformed the S&P 500, but our relative strength, especially this last week, has faltered a little bit, and that's again another one of those metrics that we're using to say, okay, hey, where should we lean into? Well, you can see where we're leaning into ETFs, and you saw UPRO RSP getting some ads today. We have a lot of exposure elsewhere, kind of spread out, but we do have the majority of that in the ETF, recognizing that the indexes are doing well right now, and so we're kind of leaning a little bit more heavily on that, while we wait to see what's happening with individual stocks. Speaking of individual stocks, probably time. Or did you have any comments that you wanted to say on this?
No, man.
Yeah. Okay, let's go ahead and talk individual stocks. We really kind of already talked a lot about UPRO and SPY. Again, we did raise that to outsized position. And when we talk about UPRO and our position there, we really are using our analysis of SPY to make those decisions. What's happening with SPY? Oh, SPY's over 600. Okay, now we're gonna, we don't really care what UPRO is at. We care that SPY is over 600, to make a lot of those decisions. But I also, because you were just bringing it up, NRG is one where a lot of people might not have understood, hey, what's the problem here? This isn't doing anything wrong, because we put NRG on June 2nd. It was a nice move on June 3rd, and then June 4th, we're like, nope, we're out. And this looked beautiful. I'm going to go back a little bit, just to take off to this week. But I mean, you look at this week's action, or even the prior week, and just how tight this was. I mean, you really couldn't ask for anything better than that, with a big gain, just not giving anything up. And that's where we put it on. But why did this come off, Mike,
I don't
on
know.
this day?
Well, we have a sash of coins, and I flip them, and if it's heads, no, sorry. Look, we were talking about this pre-show. There's a bit of two things. There's a time-based stop as well as an expectation breaker that was happening here. This was beautiful, like one of the best looking setups that I've seen in a long, long time. To have a move up 52% out of that pivot in a blink of an eye and then hold in tight, like 52% move, as you can see with the flag, that happens not all that often with
Hmm.
a liquid name, but you don't have that type of move and go sideways that tight. I mean, that's so rare. Like if we did a query for that, you're not going to see many of those, and when you do, they go higher. So that's why we took a shot at it, even though it was in nosebleed territory. Then that
And I would
very
say what you usually see is probably if you move this week to to right after, that's what you usually see, right? You see that
yep,
50% retracement in the strongest stocks.
yeah,
You get that 50% retracement and then you come back. But it's rare that you get like a, what was that, a 10% retracement? And that was
yeah.
about it.
It was like non-existent
Yeah.
retracement. Like it almost seemed like the stock was being acquired or something.
Mhm.
It was so tight. Let's go back to the daily to kind of walk through this. So you had that top day, where is up there where the old marked high was, and from there, would have been normal and natural would have been another big move the next day, like a 4, 5, 6% move, and that's what the team was expecting. And when that didn't happen, we're like, whoa, something's off here. And so that's where the expectation breaker thing comes in. And that's why we backed away. I thought we were just going to get shaken out and it was going to turn back and go up. But again, we're managing risk and not, doing the whole FOMO thing. So we backed away from it with the thought that we were going to just get right back into it if it took out the high of that blue day. And it didn't. It came back, it's in at the 21 day. So there's no reason for us to buy it here. But if we get an upside reversal, that's
Mhm.
something that we might want to give a shot. It just depends if we have space in the account at the time. But so there's two things. One, if something breaks your expectation, just back away. Another thing is there's a time element where you put something on and the first day you give it, let's call it like a full ATR to wiggle and wobble. Then the next day, maybe you give it 3/4 of an ATR from your initial um, entry price. Then the next day you keep on inching that up until it just stops you out of that. So each day you want to increase your stop for swing trading, this style of swing trading. When you're position trading, you can give things more room and you can give it all the way down to 7%. But that's really not what this product is about or this style of trading. So, again, to just summarize, there's a time element where you're kind of raising your stop up each day. And then there's also that expectation breaker. So, with the time, it's not as it's not as time sensitive, right? Because it's just, oh, you can give it another day, but you don't want that quicksand type of thing where it just inches down, and then you're like, oh boy, I should have sold 4 days ago. We would rather just sell at the first chance. Like Bill said, there is the quick and the dead, and we'd rather be quick with swing trading and then be just willing to buy it back.
Absolutely. And looking through the comments, Kirk was asking about, do you use ATRs for stops? Of course,
Yep.
so we just talked about that. And sometimes we're using like, hey, after a week or so, if we haven't made progress, I mean, we should be up on the position. If we're not even up on the position after a couple of weeks, well, why are we holding it? And look, we didn't know this was going to come in as it did, but um, by not really kind of giving things room to just um, take up space for us, why hold on to that risk? Because things can always happen, right? Overnight, things can always happen, and if there's no cushion, then kind of why give it that space? I also wanted to just acknowledge I'm reading in the comments here that Jeff is going to be retiring in 2 weeks, and he plans on doing trading kind of a lot more in retirement. So congratulations on retirement there, Jeff.
Dude,
That's
congrats,
that's
man.
awesome.
I mean, retirement, I don't even know what that is. Like, I don't like, I'm not thinking, well,
And
but
I also want to appreciate our good friend Tim, Tim's efforts, talking through a lot of things with some of the folks on YouTube. He of course has been to Founders Club meetings, and he's been on Swing Trader for a while. So
it's
uh,
such a great community of
mhm.
people, and we really think of this as an IBD family, an extended family of folks, and we all appreciate all of the feedback. Well, when it's good feedback, we don't appreciate the negative feedback.
Well, we also appreciate the constructive criticism. So
No, you
that
do. I
helps us
don't.
get better, right? So yeah. Yeah, let's talk a little bit about RCL. This was another one where we went with an oversized position here for a while, and it really seemed warranted. This was doing pretty well, but then we backed away. And so why back away when you've got that cushion?
Well, we backed away for a couple of reasons. One, because our equity curve was not doing what we wanted to do, as we were discussing. And so when you have an oversized position, you want to think every day, just because you did something yesterday, every day you come in and go, okay, is this still warranted? And based on how we were doing, as well as where the position of this particular stock, it felt like it would, come in. And in fact, it looks like it wants to come in one more day. Like that would be normal and natural to me. I always think in terms of the kind of like 2.5 or 3 days down is normal, and then kind of
Hmm.
bounces back. So if we were to get a shakeout tomorrow with an upside reversal, we might increase the position size. I still like this a lot, but if I was position trading it, I just leave it alone. But we're not position trading. This isn't leaderboard. This is swing trader. And so with swing trading, we're like, okay, let's lock some in hopes to increase that position, um, if it sets up and the risk reward makes sense. Like this is not doing anything wrong. It's just, had a little mini downside reversal yesterday and came in today, which met our expectations. And maybe it just goes sideways for 4 or 5 days or so and gives us a chance to increase it. I want this back up to a full size position, but also we were making our individual stocks half size, and that was the one sticking at, it was like sticking out like a sore thumb to us, of like, does this really warrant this exception? And it didn't. I would we preferred putting that extra half into UPRO and RSP, but it still looks. I still like it a lot, and yeah, I think it's not doing anything wrong.
Yeah, absolutely. And you know what? To your point, yes, this is a swing trader product. But someone was mentioning in the comments how hey, sometimes I think the guys are selling too early, and I hold on to them. That is great. We love to hear when someone is making more money on on an idea than what we're necessarily taking out of it. But we are sticking with generally a swing trading product. There are times where we've held on to something for a month or more, that we've done that. But in general, we are kind of sticking with the swing trading rules, and we'll move on to the next one. But we think it's great when people adapt this to their own style. I always say, hey, I like to sometimes start my trades as swing trades, and if they earn the right to become position trades, I'll let that happen. But I never do it the opposite way. I never say, oh, I want to start this as as a as a swing trade, and when it's not working, oh, now I want to turn it into a position trade because I don't want to admit that I'm wrong. That's the kiss of death. So I don't do it that way. But if something is working in my favor and I got a lot of cushion on it, sometimes I will turn swing trades into position trades. Nothing wrong with that in my book.
Yeah, I think those are some really good points that you were just talking about. So this is how I would use the product if I was on the outside looking in. One, the most important thing would be, how deep in the market is the team? That is everything. And everything flows back down from there. Then look at our position sizes and where we're allocated, are we heavy in ETFs? Are we heavy in individual stocks? What sectors? To give you an idea of, where we think makes sense to be exposed. Then you look down at the tactical things of, okay, well, the guys were buying it here and then they're selling it here, and it's not doing really anything wrong. You can hold it, like what you were saying. We might be just saying we want to lock that in because we see something better over here from a risk reward in a short period of time, that we think this thing has a chance of going up faster than this one, like the RCL that we were talking about. It's not doing anything wrong if someone wanted to just hold it, even with an oversized position, as long as you have.
Oh, I think I forgot to say that I have a position in that. So yeah, we always have to disclose
Okay.
that, and I do have a position in that.
I shut down my accounts, my broker accounts. I think I might have a remnant
Mhm.
of some too. I'm not 100% on that, but anyways, with it again, overall, looking at how deep in the market, where we're at, what position size we're doing. But if we remove something, and lots of times you'll see us removing things because we've been adding a bunch of stuff, and so we're looking at how deep in the market are we, and go, okay, well, we can't go any more than 100%, but we really want more money in this one thing. So we got to sell something. And that's what we're doing, is we're constantly looking to see risk reward, because our goal is to stair step our equity curve. It's not to buy something at 100 and sell it at 300. That's not what this product is. It's about managing risk in a swing trading type of an environment. Now, if we get some of these that we can hold for a month plus or whatever, that's great, and we're totally open to that. But that's not what the key goal or the intent is. The equity curve, we want to outperform the S&P, but really we want to do it in kind of a very methodical way. It's
Mhm.
just not just randomly doing stuff. And so really think through. There's not one decision that we ever make on here that is random. It is very well thought out. Doesn't mean they all work. That's just not the way the market is, like,
Right. Yeah.
unless you've got a crystal ball. And
Yeah.
the other thing is, there's a lot of hindsight that goes on, in the marketplace. In with our minds too, is like you sell something and it just keeps going higher, and that's the one that you remember. You don't remember all the ones that you sold that then, oh, those were good sells. So it's a tricky game, and it's a fun game, man. So I hope people take the product, but use the product. Like, really don't just see like, oh, they sent 15 alerts out today, what are they doing? Go through and think, okay, why would they be doing this? Why are they increasing their RSP position and at the same time decreasing their RCL position? Well, we just explained why.
Yeah, exactly. So, well, that wraps it up for us this week. Thank you, Mike, as always. And don't forget, again, Mike was on a couple weeks ago on the podcast. You can get that at www.investors.com/podcast. You can kind of check it out there. We're going to have Scott Bennett on this time. Some folks were asking about having Mark Minervini on, and yeah, he's on the podcast. Not this one, but on that Investing with IVD podcast. So check that out. And we are going to see you next month.
Wait, I wanted to
Remember,
say one
oh,
one thing to all the fathers out there, and especially to the best father in the world, my father, a happy early Father's Day.
yeah, absolutely. Coming up. And yeah, next time you see me, I'm probably going to have new digs, or actually transitional digs, because we're doing a remodel. So this is going to be going away for a little while, and hopefully back in a more grand. No, I don't go grand, but we'll be in a different location. I'll be more of the Webby basement style for a little bit.
There you
Yeah.
go.
So thanks to everybody for watching. Really appreciate the support, and we'll see you in a month. Take care. Bye bye now.